you're lucky if you have 4 things to buy. To ask for 20 is really asking for egg in your beer. Very few people have enough brains to get 20 good investments.
Well, and now we're at the egg in the beer part of the show. What you've all been waiting for.
This podcast contains the arguably witty banter of 2 friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
We got some victory, player. We got some victory.
What does that mean?
Victory! You ever watch Entourage?
Oh, did I ever? Yeah.
Yeah. Remember when, what was his name? Johnny Utah? Well, no, that was from Point
Johnny
Break.
Bananas? No, what was his name?
Yeah, I don't know.
Johnny
anyway,
Cupcakes?
The brother. Yeah, Johnny Cupcake. Johnny Cupcake. Yeah, the brother, though. He would go, victory, because of his show. But anyway, that's not what this is about. This is about the U.S. women's national soccer team. And so for ever, I'll call it, but for years, they've been saying, look, we done dominate this whole sport. Like, we dominate this sport. And you're talking about paying for talent. You're talking about paying for whatever. And we get paid, I think it's something like 80 something cents to the dollar, right? Compared to men. And then we don't get the bonuses and whatnot. But this week, $24 million in back pay, plus more in like, they're going to donate to charities and all that kind of stuff for it, which maybe not a complete victory, right? But it's pretty huge.
Props, equal work for equal pay. But Doogles, you always keep me on my toes. I didn't think we were talking U.S. women's soccer to kick off the show. This is
am I the wrong podcast? I thought this was the pizza and women's soccer.
Yeah, the Skippy pizza. Yeah, that actually, you're in the right place.
No, it's way off topic, but huge. I'm really excited. And my fam has been talking about going to next year, the World Cup, right? Women's World Cup is in Australia and New Zealand, 2023. We done talked about going to that thing too. I love watching Little Women's World Cup.
Oh man, I love those countries too. Fabulous places to visit. Cannot recommend it high enough. I'll give you some tips offline. So book those flights, Doogles. Make it happen.
Yes. All right, I'm skipping the pleasantries, which is your favorite thing to skip because you're not very good at them. Because this week, man, serious stuff.
Somber news. So we're gonna try and make you guys smile, but we do want to start out just acknowledging the Ukrainian conflict and all the sad stuff that's happening on over there. Doogles, I was a little surprised, but very excited. We do have some listeners in the Ukraine, so special shout out. You guys are in our thoughts. We are hoping that you hold the line and things look better here in the near future, and you get all the support that you can get. And go from there. So definitely somber news. We understand that real people are impacted. We're going to talk some about the financial idiosyncrasies of that, but definitely want to acknowledge that situation.
Real talk. There's a lot of geopolitical tension, a lot of real human rights, human lives, like right to country. That's not what this podcast is about, but know that our thoughts and hearts are there. But yeah, we're going to talk some of the financial elements of it.
So we'll do a poor transition now. The financial ramifications of this conflict are mind-boggling, and potentially this is uncharted territory for a lot of our listeners, I'd say, who are typically more in their 30s and 40s and haven't been through a conflict like this in mainland Europe recently. So, Doogles, how did your portfolio hold up, and what were you thinking about on the investing side of things?
On the portfolio side of things, fine. Yeah. And that's mostly because since the peak in November, it's gotten beat down. So like it was kind of the market was kind of like, we don't have much else to, like, we done told you, sell Dexcom. You know what I mean? Like the market was like, we done told you to do that. And so we can't tell you anymore. No.
Wait, so second level thinking there, you're like, I know some portfolio damage is coming. I'm just gonna get it out of the way earlier.
Just get it out
later.
Yeah. I'm like, why wait? No, actually, my portfolio did fine. It was up like this week a little bit, like just a tiny bit. Ended up. It got hit when everything got like smashed, but then came back and then beyond a little bit. But outside the portfolio, I was doing some. I've been on the hunt actually recently, as I mentioned before, like generally. So I've been looking around and also thinking about the ramifications of this. I don't like to get, as you know, and as you don't either, I don't like to get into like the real short term ramifications of things like this.
It's a loser's game. No one should be doing that.
But I was, over the last month and a half, I've like sold off of a lot of the commodity stuff that I'd purchased a couple years ago. Potentially bad timing on that one, because there were like rising prices, but perfectly fine. But thinking about commodities a bit, and then also just looking at in general some of the like I sold. I actually owned a Russian ETF that I sold at the beginning of the year, and it was just while I was watching that, not for getting in purposes, but wow, like the fluctuations on obviously on the Russia ETF is wild. So commodities mostly, right? Russia ETF are like some of the things that I was looking at this week.
You know what's amazing that tells you about my investor psyche is I was actually wondering about Russia as a country, like the Russian stock market as a country, the investment hypothesis in like 6 to 9 months, when things hopefully it just gets decimated. I say hopefully, again, not because I want
the stock market, not the country. Is what you were talking
exactly.
About.
But anyway, so as it relates to all that, what's going on the Wall Street Journal side of this conflict, I'll call it, is SWIFT, right? And sanctions and everything else. And I think there's a really interesting conversation to be had there. For those who don't know, SWIFT stands for the Society for Worldwide Interbank Financial Telecommunication. Douglas, is that the worst name you've ever heard?
Sally is sold she-shelled by the she-shorst. It's like what I just heard.
So, Belgium-based system, 200 countries participate, 11,000 financial institutions. Pretty much the only countries that don't partake until maybe this week is Iran and North Korea, right? And there's a lot of pressure. And as of Saturday afternoon, when we're recording this, there's some momentum to cut Russia out of SWIFT.
And what this is think of it as like the communication channel, communication protocol of financial transactions around the world. So it's not the way, they're not like holding money. It's not the way money's actually transferred, right, across state lines, but it's where the payment orders come through. Mm-hmm. And so if I'm a bank in the US and I want to deal with a bank in France, right, SWIFT will be the way that I say, like, someone is transferring from the bank in the US to the bank in France. So if you cut the Russia out of that, you're basically saying that Russian banks can no longer communicate with banks outside of Russia.
Yep. As of 2020, there were 19.5 billion of these messages, they call them, but those messages relate to transactions. Of that, to get some idea of the cross-border money flow that's happening there, like if you take Europe, Middle East, and Africa, about 2.5 of those payments go to Asia. And if you look at Asia to Europe, about 3.5 go from Asia to Europe. So some of that traffic in there is probably Russia to the European mainlands. And some of those payments probably relate to energy and gas payments that have been widely talked about.
Exactly.
This is a very fascinating thing because there are ramifications with economic sanctions. People talk about the boomerang effect. And even though Biden right now is saying, oh, we structured our sanctions in a way that's not going to hurt our economy, I don't believe that for a second. Like, that's not how it works. Though the reason trade is a good thing is because you take something that one place does well or has a surplus of, and you transfer it to another place where it'd be more costly to do it on your own. So if this happens, there will be ramifications to all economies, I believe.
And it's an unknown because it's a compound effect. The last stats that I saw, these are probably like loosey-goosey thumbsuck stats, like, to be honest, is around 1% or a little over 1% of the communications that go through SWIFT are from Russian banks. But to your point, like the compounding impact of what happens when the Russian bank doesn't actually do finances with someone else, like, we do not know, which is why it's really hard to figure out whether or not you want to do this. And Russia also, back in 2014, so 2014 was when Russia, I think it was 13, 14, something like that, when Russia went into Crimea, right?
Yep. It was 14.
Yeah. So threats happen there. So Russia started building its own version of Swift, which it has. But from what I have read, it's like shoddy. It's like Doogles decided to also start writing things on a napkin and carrier pigeon, which is interesting. But what's what I was really thinking about most this week, with regard to all this stuff, it's not any assets itself, but what it is how few superpowers, or I guess by definition, superpowers few, but like really few superpowers we have in this world right now. Because as I was thinking about the different countries that could like interject here, it's really the US, Russia, and China are like the superpowers. And guess who has been? You can debate, because I know you're going to talk about the EU.
Let's throw the EU in there.
Yeah, that's not a country. My point is like that's not a single.
It's a union.
Entity
it's a union.
Country. Yeah,
GDP roughly equal to the United States. So,
but it's not.
Don't hate on my European friends.
It's not a country. But from a country standpoint, right? Like there aren't that superpowers, and China has been eerily silent. I think I think China's waiting to see which way the wind blows on this one, because I bring China up because of the superpower thing, but China has its own communication protocol for national too, which Russia could theoretically like lean on if it came down to it. But
yeah, okay,
yes,
Doogles, there's lots of rabbit holes to go down. So one of the arguments against taking Russia out of SWIFT is that even though I've seen estimates, it would reduce their GDP by about 5%. SWIFT is very much part of the U.S. financial-led world order, dollar-denominated, dominant currency. And if you kick people out of it, especially I think Russia's the 12th largest economy in the world right now, then there's reasons to develop other things and maybe get used to a world that's not U.S.-led. To me, you're going to be shocked, but this always goes, I wonder about the crypto ramifications, right? So will Russia say, like, well, okay, we don't need, we'll build SWIFT on crypto. Russia already does the third most mining of Bitcoin of anyone in the world. Putin seems to have a love-hate relationship with crypto. He doesn't really like it, but he wants his technologists to be up to speed on crypto because of some hacking potential, it seems, according to what I'm reading in the Wall Street Journal. So this is hot off the presses as well, Douglas, and I don't know if you've seen it. The U.S. is exploring if they can sanction cryptocurrency movement between Russia and other countries. Now, if you haven't heard that, give me your initial reaction, because all the crypto fans will tell you that's impossible, right?
I hadn't heard that. That's fascinating and should not happen.
So here's the pitch. This is hot off the press again. Just this weekend, the Wall Street Journal is saying that Biden's advisors are looking at if they can tell cryptocurrency exchanges who are typically regulated by financial bodies like the SEC that they cannot do transactions in Russian rubles, or maybe do transactions with wallets that are tied to Russian locations. Isn't that just a fascinating thing to explore?
That is interesting. Yeah, that feels a little different to me than what I heard you say before. Are they two different things?
That's their approach to accomplish something that is, because you can't, the Bitcoin fans, if we just talk Bitcoin, but it could be any crypto, will tell you the greatest thing about cryptocurrencies is cross-border payments and low transaction fees and all this other stuff. So this seems like the perfect situation. If I'm Putin and the world cuts me off, I go, you know what? We're going to leverage technology that already exists, that has been proven to be trustworthy. It's just a roundabout way to get sanctions. And I hadn't heard it discussed. I was curious about it, but I hadn't heard it discussed until this weekend.
That's interesting. I wonder what the volume is like in general and whether or not there was any change.
Yeah, so over
the last week.
Russian citizens, I don't have the volume question answered yet, but there's 12 million cryptocurrency wallets in Russia for an equivalent value of about $24 billion in US dollars. Held in crypto at the day. I won't let us get down the rabbit hole on that because it's a developing story. But I just thought it was interesting to mention. It's definitely been on my mind as it relates to cutting people out of the world financial system, is what alternative they would try and use to supplement that.
Yeah. Huh. Interesting. Well, look, I'm thinking about the people and watching the markets. The Thursday, Friday this week were fascinating from a market perspective. Maybe we can transitional fishbowl that situation to like what happened in the markets Thursday, Friday. What a turnaround.
So, I mean, absolutely bonkers. I was looking at QQQ because I was just curious what the volatility was going to look like. And, you know, it was not, Thursday was a terrible day. It was just terrible news all around, right? And so you're wondering how that translates to something that you and I are interested in. QQQ starts down more than 3%. And that seems like an overreaction, but fairly reasonable. Doogles, you know that 99.9% of the time, I think short-term movements in the market are completely unpredictable, and it's a fool's game to even try and mess with that. Maybe the 0.1% is when a major war is actually unfolding before our eyes. I thought if there was something that was going to correlate. What happened over the next 7.5 hours, Doogles? QQQ, the Dow, the S&P, all basically ended up skyrocketing. QQQ ended up more than 3%.
That's a massive swing. 3 to 3?
I mean, explain this to me. I know you and I were sending texts back and forth being like, did we miss something? Is the war over?
Yeah, I legit like jumped on. I was trying to search all of my news outlets, right? To be like, did Putin back up? Like, what occurred here? Like, did the US go in? What? But nothing.
So here's a little quiz for you. That plus 5% intraday reversal is the way it's structured. When is the last time that happened?
I could have sworn that happened a couple weeks ago.
No. Well,
I like that.
No.
You can swear all you want, Douglas.
According to Bloomberg here, although this is someone's processing on a Bloomberg terminal, the last time that happened was in 2009. It happened 3 times when the market was falling significantly. And what would happen is there'd be like this really negative trend of news, and then it'd be like, oh, but the Fed might cut rates, or so the market would freak out intraday and be like, oh, this is happening. The last time this happened before that was all the way back in 2003, and it happened several times from 2000 to 2003 again, as the market is generally headed towards a downtrend. Yeah. So seeing the market,
those first 2 years were market bottoms though. 2009 and 2003 were market bottom years.
On the way to bottom is all I'm trying to say. Not at the very bottom, but exactly.
Yeah. It's the like explain yourself thing that people are coming out with, because you mentioned interest rates. I'm bringing this up is that now there's a belief that the Fed will not increase interest rates nearly as much as it would have anyway because of the uncertainty. Who the heck knows? I mean,
can we make jokes about the explain yourself thing? Because the Wall Street Journal, who is my favorite newspaper and I respect greatly, at 7:30 in the morning said NASDAQ down 3% on invasion of Ukraine, and ended the day saying NASDAQ up 3% in massive reversal on filling your narrative, whether it's that the Fed might not cut rates or whatever.
There was actually one point where it was the same sentence, but the only thing that changed was the word down and up. Like I saw this. that was all that showed. We'll have to see. This is I feel like the market is trying not to crash. Like it is that people are not ready. The people are not quite ready yet. All right.
I'm not making predictions, but it feels like volatility is bound to be with us in the near term, because like it's crazy out there.
And speaking of, I'm going to name something that we weren't speaking of about at all. Speaking of crypto haters, I'm going to reach into the fishbowl and pull out my good friend, Charles Munger.
Oh, yes. My boy,
Charles
Charlie.
Munger, known as Charlie. Yeah, only his good friends call him Charlie. I wanted to be formal here. But yeah, so Charlie Munger, he is the chairman of the Daily Journal. For those that do not know, it's a newspaper out in California. And much like Berkshire Hathaway has their annual meeting where Charlie and Warren Buffett sit up there and they answer questions from the audience. Charlie, because he has this platform, right? He gets up there and answers questions from the audience during the Daily Journal weekly meeting. So first of all, their meeting was awesome. It was exactly 15 seconds. So I watched this. It's about a 2-hour video. It happened 10 days ago. So I watched this. The meeting was 15 seconds. He gets there. He goes, "We all voted. I'm still here. He's still here. We're good. All right, ask me questions." That was the actual meeting. He is such a curmudgeon. It's wonderful. Oh, yes. And the man is 98 years old and embraces his I'm 98 and you can't tell me what I can or can't say. I absolutely love it. So I'm going to raise 3 or 4. We'll see how far we end up getting here, but depending on the level of interest, 3 or 4 different topics that he raised. And I want to see if it's worth discussing with you because I found them to be interesting. So one, he called I would say between US, China, and Russia, called all the leaders idiots.
Yeah, that's a Munger thing to do.
Yeah. What he was saying, he oversimplified this to the extreme, but sometimes it's helpful in these cases. Specifically, he was mostly talking about US and China. He went, if the US and China don't get along, what good happens in the world? You'd be stupid to believe, and that's the quote, you'd be stupid, right, on either side of that to believe you're not going to get along, which I thought was really fascinating. There were a lot of questions around Alibaba. I'm going to transition that to an Alibaba point, and then we'll talk about that. Many people had questions about Alibaba. But so the question around investing in China and Alibaba, someone asked some version of a question that was your boy Warren said this is a bunch of hogwash nonsense, garbage. So can you explain yourself as to why you think this is a good idea to get in? I love this. This is what he said. His quotes are a little bit long here, so bear with me. But he goes, Warren, like many other intelligent people, likes to invest where he personally feels comfortable. And for some reason, I'm more comfortable investing with the Chinese than he is. That's a minor difference. I think let's come back to that phrase. I think it's really interesting. That's a minor difference. I have all kinds of places where I'm just like Warren, and I won't go near them. I think an old guy is entitled to invest where he wants to invest. That was his response.
I'm 98, deal with it at the end, right?
Yeah. What I loved about this, so one, just I'm 98, deal with it. I love that. But that phrase I mentioned in the middle, that's a minor difference. I loved the fact that he said that, because what he said before that was just he's comfortable with stuff. There's stuff that he's comfortable with. I'm not. I'm comfortable with this. That's a minor difference. I like that. I think what that said to me, maybe he meant something different. What that said to me was the investment philosophies that we look at, they actually might be similar, right? All else being equal. But Warren might be able to do some investment analysis on this. And he might say, yes, it looks like a great investment, but I'm not good with China. Yeah. So the minor difference is just level of comfort, which comes back to so much psychology we talk about all the time. So I loved that quote.
Yeah, I want to pull something up because I do want to talk Alibaba a little bit, and I want to have my facts in front of me. So we don't give investment advice on the show. We do give research recommendations. We've been talking about Alibaba because it's really interesting for probably 6 months back when Munger first took his position, or it became public that Munger took his position. So Alibaba also had earnings this week. I'm not going to read you the earnings report. There was a negative reaction to it because top line revenue growth was slowing, competition is heating up, and profit margins aren't what people hoped. The business also kind of has to evolve with Chinese regulations and some other things. So, Doogles, you probably know off the top of my head, I'm going to go from memory. I think top line revenue maybe only went up 20%.
Yeah, it's about that.
And it had been going, previously it had been going gangbusters, 50 to 100%, right? Yeah. So the intriguing thing about the stock was the growth. In the past year, the stock went from about $240 a share to about 108. So one, I just want to laugh at that. People are freaking out about, the revenue only grew 20%. When the stocks been more than cut in half. So, there were people holding this stock 12 months ago that were buy Baba at $240 a share. Look at these growth metrics. Look at I guarantee if they said, well, it only grew 20%, they'd be disappointed and they'd say maybe that means it's only worth $200. But the disconnect from the price movement in the stock to the story that's being told around the stock, and this is not, I'm not telling you to buy BABA in any way, shape, or form, and just using it as an example, I think is kind of hilarious. Because if you look at any of the multiples, it's like, well, yeah, if the stock went down 55%, I wish the revenue grew at 30%. But
yeah,
but like the stock's down 55% from where it was.
and I think that's putting that first point I brought up around that Munger was talking about in this quote. I think that's basically his take. Plus, he's 98 years old, so who the heck cares, right? But I think what he's saying here, he's talking about how he's basically, in not so many words, is like the investment thesis. If you look at the fundamentals, are solid, right? Like, period. That's kind of his take. Then the second one around when he was calling everyone, all the world leaders, stupid. When he's doing that, what he's saying is like, he goes, if I'm wrong, I'm going to be wrong because China and the US don't figure out how to get along and they spit at each other for a long time. And that's dumb. So what I'm going to believe is the fundamentals are so strong and they'd have to be stupid to do that. So I'm going to bet on them not being stupid. Like that's basically his investment thesis for this.
And I think that makes sense. He's a big proponent or believer in incentives. And if you just look at those countries and what helping their people be prosperous, it is good for China and the US to at least, like, be civil with each other, be able to help each other make money, be able to help each other prosper.
Now I'm going to transfer to my second quote from Charlie Munger. And this one's going to come off of the fact that BABA is a pretty big holding of his. I think it's like his third largest holding. Mm-hmm. He doesn't have many holdings, really. And so third largest is like, right. But so he was asked about diversification. I'm a staunch believer in concentration. You have good concentration. I am not a staunch believer that the vast majority of people, I'm talking like 98% of people, should not be concentrated. Yes. I believe that most people should not be, but my own portfolio, I am. He talks about diversification, which he does not believe in. Like, it makes that very clear here. He talks about the Mungers a lot in here. Like, he is the Mungers. But anyway, he says, so he goes, they were asking about how concentrated he is. And he goes, the Mungers have Berkshire stock, Costco stock, Chinese stock, and a little bit of Daily Journal. First of all, I thought that felt really dismissive, given that he's at the Daily Journal. Like, that's the only one he said, like, a little bit of Daily Journal. And then some apartment houses. Okay, so that's what he says. He goes, do I think that's perfect? No. Do I think it's okay? Yes. I think the great lesson from the Mungers, again, he is the Mungers. Yeah. I think the great lesson from the Mungers is that you don't need all this diversification, and that's plenty. You're lucky if you've got 4 good assets. If you're trying to do better than average, you're lucky if you have 4 things to buy. To ask for 20 is really asking for egg in your beer. Very few people have enough brains to get 20 good investments.
Well, and now we're at the egg in the beer part of the show. What you've all been waiting for.
Exactly.
Diversification's a thing we could have a whole episode on. I mean, Buffett has done some really good research that will say if you get 5 to 8, which is similar to what Munger's saying here, you're in pretty good shape. That being said, if you're looking to go bankrupt, the best way to do it is to hold less than 30 stocks. It just is. Yeah. Because you can have a couple disasters hit. Now, Munger is one of the most talented investors ever, and his 4 stocks are not the same as 4 picks for me and you, or 4 picks for your average investor either. So I just trust him here. His process is his process. He's 98 years old and worth billions of dollars. He can deal with it. I don't think it's good advice for your average individual.
No, but I love the way he says things. Like, if nothing else, like, egg in your beer. All right, last thing, and we can move on from Munger here. This is about hoarding cash, even specifically. Yeah. So, like, basically having cash and waiting for the time to invest it. His reaction to that. In my whole adult life, I've never hoarded cash waiting for better conditions. I've just invested in the best thing, I guess, I could find. And I don't think I'm going to change now. And the Daily Journal's used up its cash. Now, Berkshire has excess cash.
Has not. Yeah.
Quite a bit of excess cash. But it's not doing that because it knows how to time investments. He, meaning Warren Buffett, he just can't find anything he can stand buying.
Yep. Yeah, he's not buying Alibaba right now.
Yeah. I hadn't quite thought about that nuance that he put in there before. Because you say, like, if someone, I think Berkshire has like $147 billion, I think is the last thing I saw they had in cash. It's a lot of cash. The difference between hoarding the cash and waiting for the right time and wanting to spend the cash but not finding the right thing are same outcome, potentially, but very different philosophies that I thought was interesting in the way he stated that.
Yeah, so I'm going to try and thread a needle here and agree with both Buffett and Munger, and you can laugh at me when it doesn't work.
You talk about the Muffets?
So if you happen to be glued to your portfolio on Thursday, trying to figure out what it was going to mean for you, I can guarantee you that if you had a little more cash than average in your brokerage account or in your savings account, that probably relieve some stress for you, right? Because you were watching things, maybe this was only Thursday morning, you were watching things kind of blow up and a lot of uncertainty with what's happening in world events. And having a little cash in those times provides nice peace of mind that I don't think makes sense. That said, Doogles, we talked 2 weeks ago about staying invested and the pros of that. I've done all sorts of research on this over the last decade and consistently am deploying the capital I have. I have dividends and other things rolling in that keeps, there's a cash balance on the side for me, but pretty much I'm invested because that's the way you make a great return long term. So the only thing I'd say is think about that. I think there are turbulent times ahead. And if your psyche is such that you might need a little more cash than average right now, take the Warren Buffett side of the equation. If you're in it for the long haul and you don't need, you're talking about accounts you don't need for 20 years, then you should be fully invested and you should just make sure that you can ride out the turbulence.
And there's something very, 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 very important to keep in mind with regard to the Warren Buffett side of things. And that's that it's $147 billion. Like, that's a big difference. But there might be people also that listen here that have $147 billion of cash that are waiting to invest it, but I doubt it. And the
Hello,
reason
Mr. Buffett.
Yeah. Hello. I'm not sure why.
He doesn't know how to podcast. I don't think he has a cell phone. He certainly doesn't have an email.
He's like, can you please print out the Skippy and Doogles transcripts so I can read them? The reason I state that is because in order to make a dent in the Berkshire portfolio, he has to deploy a solid amount of money. Like, he's talking about deploying 20, 30 billion, maybe a little less, but like billions of dollars at a time. So to be able to do that well is very different than, if you're sitting on 10 grand or 20 grand or whatever you might be sending. You can find liquidity everywhere if you're sitting on like a small amount of money. But for him, he has to like buy a company. Like it's a very different or a solid portion of a large company.
You're looking at capital. The top, the 30 biggest companies in the world, maybe, to be meaningful for him.
Exactly.
That's a very good point. So should I go back and watch the Munger 2-hour setup, or did you catch me up with all the highlights?
I think it's worth watching because seeing him in action, he just doesn't care. He is Honey Badger. Charlie Munger is Honey Badger. It's brilliant to watch. I can't do it justice just by talking about his quotes.
Our friend William Green was live tweeting some of the stuff, as was Trent Griffin and some other really smart investors. So you probably saw that.
Yeah, I was actually watching. I was sitting in bed, and I was like laughing, and my wife's like, "Oh, what are you watching?" And I'm embarrassed. Like, I'm like, "Oh, old episodes of The Office." I'm embarrassed. Anyway, all right. What's next in your fishbowl?
All right, just one thing. We love dollar stores around here. I just want to hit this quickly. Now, Doogles, your favorite dollar store is Dollar General, right?
Speak it.
And my favorite dollar store is Dollar Tree, even post the move to charging $1.25 and $1.50 for certain items. I just wanted our dollar store fans to know that hundreds of family dollar stores, so it's not a favorite dollar store of the Skippy and Doogles show,
but owned by Dollar Tree. Don't try and back out of that.
Hundreds of family dollar stores closed after rodent infestation at the warehouse. And some of the stuff they describe with this rodent infestation, let's just say It'd have to be pretty large to have 400 stores temporarily closed.
That's terrible. That would never happen at Dollar General. And if it does, I will scrub this section of the podcast. That is terrible. That's really like that's real. That's real.
Yeah, sorry, I'm not trying to laugh. But sometimes, what else can you do? They close stores in Alabama, Arkansas, Louisiana, Mississippi, Missouri, and Tennessee because they may be unsafe. Yeah, I won't even read all the rodent stories, but skip your trip to the dollar store this week. Go back when they scrub things down.
It's one of those like compounding on the negative side things we talk about, that the people that need to shop at these places, like if we hop in there, it's because you can get the thing for cheaper. Some people like need to shop there. Hey, come on now. Like you can't be skimping. This is the ultimate skimflation. Like when you are skimpflationing on $1.
No, listen, we've been talking about skimflation a lot, and the $18 eggs that you got claimed were a gourmet breakfast, all this stuff. Well, when you raise minimum wage up this much and you start asking rats to do your manual labor, though your warehouse, Dougal, like this is what happens, man.
Ratatouille is a good movie. That's just a good movie.
Yeah,
anyway.
And listen, I advise them to use robots rather than rats, but they went with the McKinsey consultants instead of me, man.
Okay, all right. You're throwing shade at all kinds of companies right now.
All right, moving on. What's in your fishbowl?
All right, I saw this story that I thought was real solid. It's the title of this piece is "The Horror, Heart of Darkness" reference there. The horror of the Peloton not even plateau. So this is on Substack, and helen.substack.com is where this is. I thought this piece was real solid. So this piece is about Peloton, but what it's really about is unrealistic growth, and the way that the market and companies can also take that unrealistic growth expectations and take that and run with it to their own detriment. So I'm going to give a few pieces from the piece itself, want to get your hit on it, and then raise something that it kind of brought up for me. So Peloton, you're familiar. Millions and millions of bikes have been sold over the past 5 years in Peloton, right? I mean, if you talk about a company that is not successful and throw out Peloton's numbers, it's silly almost. Peloton has over 6 million subscribers. It has a 1% churn rate. You would do anything as
really
a business
solid
for
metrics.
That. Yeah. Really solid metrics, right? And the articles that you see right now that are coming out are Peloton is over. Peloton's over. Peloton's laying off staff, right? And the reason this article, what it's saying is the reason that is it's not that the people that are writing those are necessarily silly. It seems like a contrast to its numbers, but it's that Peloton's so overinvested and ate its own dog food, drank its own champagne, whatever idiomatic expression you want, and started building out infrastructure for this basically fake growth.
Well, I mean, let me jump in there. Did you see the story on one of the executives that was waiting for some stock to vest, and so he had I think it's 30+ million in paper value of his equities that he loaned against, and then the stock went down 300% or whatever it went down, and now he can't cover his loans. I mean, there's lots of problems. There's problems with the bank that loaned him that money for. Anyway, it seems like they drank a little too much of their Kool-Aid for sure. This is another case, Douglas, where maybe the stock price and the story of the company are a little disconnected. The stock price has gone down so much recently that people are writing that story without looking at the true fundamentals and saying, hey, there's actually some positives there. And it's still a product that most people love.
It's very true. But when you overinvest, this is the issue. Read you a couple things from this article here. Peloton's not over, but it does have to contend with the exponential growth imperatives of a tech company that IPO'd weeks before the pandemic. And over the last few months, the company has ceased to grow the way it did when millions of people had no other options for exercise, and several years worth of organic demand consolidated into a few months' time.
Yep.
Right? That's the point. They overinvested in infrastructure, on staff, and on general expansion, while also making stupid, reckless mistakes like refusing to recall their tread for months after a malfunction led to dozens of injuries and the death of a child. Truth. Then the last piece is, and this is that sums it all up. The stock market failed to understand the growth for what it was, but so too did company leadership. And like, that's it. If your stock flies high and crashes, it's funny money.
Yep.
Right? Who cares?
Yep.
But when you believe that, and therefore your SG&A starts increasing exponentially, you start taking out loans to buy your $30 million yacht.
Well, that's why I told the story of the executive, because the executive, and clearly you would think this was true for the rest of the company, thought that the one-time pent-up demand that all got pushed forward to the beginning of the pandemic, they thought that was like the new normal. And as Peloton, you were the startup in the fitness space of the last decade. So how many Peloton competitors are there that did either tried to build the same thing or tried to take that revolution, whether it's Mirror or there's thousands of them now. So there's way more competition in the space. You push pent-up demand into like a 6-month window. The executives of the company at that time should have realized that and said, when this busts, it's probably going to be really lean for a really long time, because we sold 2 years worth of bikes in 6 months. And then we're going to have a lean 18 months, and then we hope to survive past that. It doesn't seem like that's what happened at all.
Not at all. And these are the times when, from a company perspective, not an investor perspective, but from a company perspective, it's so important that you have these, what I'll call opportunities, right? This is a rare opportunity. I'm ignoring all the negative that happened during the pandemic and everything. But from a company perspective, this is an opportunity. And you have to say, what is this an opportunity for? And what they said, just at the high level, I'm assuming, is this is an opportunity for land grab, for expansion, to make sure that we can grab as much demand as possible. Not as, I'm rephrasing a little bit of what you just said, they did not see it as, this is an opportunity where we can fortify our company. We can use this demand to fortify like our cash balances to make sure when the other side of this hits, because this cray-cray-ish don't last, like it never does, right? We can fortify our company. We can take advantage, build enough to take advantage, right? But fortify our company to the other side. And those are very different mentalities. And it's real important.
It's interesting though, because being a high growth startup that had recently IPO'd and stuff, your management had to have the perspective of daring growth, like growth against all odds, right? That's kind of how you get to the IPO stage, and then to turn the switch and say, now we're going to be conservative with our financials. And go ahead.
I get that. I think that it may seem like a nuance, but I think it's so important that it's not, I'm going to pick on the word conservative. It's not conservative. You're still real aggressive. You're just not, you're like responsible. And what I mean there is you have to think about what you're investing in. Because when you start investing in hard assets, right, fixed costs, like there's a fixed variable component. If your fixed costs are high and your variable, like your income, right, revenue ends up being lower, you still have those fixed costs. And so it depends on the cost of your growth, right? There was something that someone once talked about that I thought was so smart. They said people always think about the cost of failure, they don't think about the cost of success. And I think that's what's important. What is, if we end up investing in this thing and then success begets success, what does that cause us to do? What does that cause for our cost infrastructure to look like? And then what happens on the other side of it? Because this is hardware, it's like real different than if you say like Wordle is exploding. I'm going to invest in more like AWS space to make sure that like Wordle can, right? I'm going to make sure that's so different than like a bike, like manufacturing, and like it's real different.
Is that where you're going with the fixed cost analogy? Because part of me thought you were going with their ramp up in hiring and the fact that their expenses. It's
all of it.
It's all of it.
It's the manufacturing, the hiring, right? It's all of that stuff.
This is a fascinating one. I mean, I'll tell you, at the time that this was happening, I kind of understood the excitement around the stock, but I didn't do a deep dive. I certainly didn't say, and the thing's going to explode in 24 months. Like, it seems so obvious that it probably was going to, with hindsight being 2020.
Yeah, this one felt even more obvious than Zoom to me. I mean, Zoom was way overblown, but Zoom was one of those things that like I can see where it could become like fully ubiquitous and they could find other product lines and whatnot.
Mhm.
Peloton is a luxury item. And there was a
Yes.
period where that luxury item, there were people that couldn't afford the luxury item that also got stimuli up in their situation, right? And so you could start affording things you couldn't afford. So I could see where like that luxury item, especially given what was brought up here around no other exercise options. But yeah, it just didn't make any sense to me. All right, here's can I drop one, the business thing it made me think of?
Please do.
All right, so it made me think a lot of the 20-mile march, Jim Collins' concept of the 20-mile march. Is that something you're familiar with? Have we talked about it before?
I don't believe so.
Okay. So the 20-mile march, the reason that it comes into the, I'll give like the non-business context and then I'll give the business context, is if you have a long journey ahead of you, right? The example that he gives, Jim gives in the book, Great by Choice, is if you're going across the country from San Diego to Maine, right? You have many different, depending on when you leave, you have many different climates, many different terrains, right? That you have to get over. And so it's 3,000 miles. And those that ultimately are successful are the ones that say, every day I'm going 20 miles.
Yeah.
That's what I'm going to do, right? Every day I'm going to do 20 miles. If I wake up in the morning and it's snowing outside, I'm doing 20 miles. And at the end of that, I'm not going to like myself, right? If I wake up in the morning and it's like perfect conditions, I'm doing 20 miles and I'll be able to rest at the end of the day. But you're always doing 20 miles. And it's those organizations or those people that say, oh, it's so nice outside. I'm doing 200 miles today.
Mm-hmm.
And then I'm exhausted. And the next day it's snowing. Oh, now I can't do any, right? Like,
yeah, I have blisters on my feet and yeah,
Exactly.
It starts to derail from there.
Exactly. That came up here for me so much because I think that march is brilliant. The company, there are two companies that like exhibit this a lot, but the one I'll bring up is Southwest Airlines. And because Southwest would not grow as fast as it could. It always would not grow as fast as it could. During its like heyday of growth, there were airports that were like, we want you to take all these gates. And Southwest was like, no, we're not coming there. That's not what we do, right? We're going to grow like the amount that we want to grow because then we can fully control our fate, our cost structure, etc., which I think is brilliant.
So there's actually an analogy there with the clothing brand Patagonia as well. So it's 100% owned by the original founder, and it's been organically funded because early in the company's history, there was a pullback where he had to do layoffs, and he really didn't like that because he had grown his company by hiring basically friends and family and people he trusted, you know? And so since then, he really pulled back and grew much slower than he could have, funded everything organically out of that fear of ever having to go through a layoff cycle again. Now, who knows what the future holds? I'm not saying that's going to hold true in the next 10 or 15 years because it's a much larger company than it used to be. But there is that discipline can be an incredible asset as you grow a business if you grow at your own pace.
And your point before around the high growth like mentality, it's the balance that's really important. And the more like experience you can get, the more I think that you're able to figure out how to balance those two things. Like, how do I grow aggressively but responsibly?
Yeah,
right. That's the end. Not responsibly as in necessarily conservative, but responsibly in thinking about what's the cost of success and what's the cost of failure in these situations, and have I made my cost structure such that I can avoid the death line on the other side? It's real morbid, but whew.
All right. There's so much this week. I'm going to mention two things, and if the listeners want us to dive in, we'll kick them for next week. So my boy Connor Daughtry, who wrote the amazing book about California real estate, is back with a New York Times article about, it's called "The Next Affordable City is Already Too Expensive," where he profiles Spokane, Washington. Really fascinating stuff. If there's interest there, we'll dive in. That ties to another brilliant article that I came across this week about ski areas and how dire the economic situation is in ski towns, which also relates to kind of the way real estate is evolving in the US. One stat from that is in Aspen, Colorado, since 1970, wages have grown about 30%. Yet the per capita income during that time has grown 300%. So the average wage is about $50K. The average income per capita is $155,000. if you don't understand how that's happening, it's a little counterintuitive. It's because millionaires from places that aren't typically Aspen are moving into town, and they don't care if their home costs $2 million, $3 million, $10 million, because they're sitting on $100 million over here.
Yep.
So this disconnect is really fascinating. And that happens in a place like Jackson Hole, Wyoming, even to a greater degree, because Wyoming has crazy tax breaks for wealthy people. So on top of the home price not mattering, then you get a tax break that might relate to more than $5 million. So the home's effectively free. Really interesting stuff. If you guys want us to continue that deep dive on real estate, we'll dig in there next week.
If anyone was curious as to why Kanye moved to Wyoming, Skippy just gave you the answer.
I actually didn't know Kanye had a place. I knew he liked the Tetons, but I didn't know he had a place there. Yeah. There you go. Okay, and then the last thing I'll hit on, relating back to a Bloomberg piece on investing. This was simply about the drawdown that happened, and this was actually published midweek before the Ukraine breakdown. So the decline from the 52-week high for the S&P 500 index is about 11% right now. For the NASDAQ, it's 20%. And then we've talked about some of these other names. Names like Zoom and Roku. Zoom's down 71% from their high. Roku is down 78%. This article breaks down what type of stocks have been hit significantly in the Russell 3000 index, and finds a story which I like, which is why I'm talking to you about it, Doogles, that the expensive stocks have been hit significantly more. So if you look at price to book value and the median decline from 52-week highs for the Russell 3000, you can look at it two ways. You can look at it by profit margins. The highest profit margin is down about 15%, and the lowest profit margin is down almost 60%. And you can look at it based on price to book values. The lowest price to book value, which would be a good thing in this case, is down about 18%, and the highest is down about 35%. So I just want to mention it because you're really seeing the type of stocks that have been hit most severely have been those high flyers, those Cathie Wood type stocks they were incredibly expensive. I mean, we'll see where that goes, but that trend may continue as there's more fear in the market, because you fly towards safety, and value stocks are typically thought of as safer stocks, more predictable cash flows with less debt.
Yeah, I'm really fascinated what's going to happen there in these, because the market has been so interesting over this period of time, because it's just like transfer, not exit necessarily. I mean, what I mean by that is like what you just said. If the S&P 500 is down 11%, but these stocks are down 78%, money is staying in the market, right? Yep. To your point, it's just transferring.
It's rotating.
Exactly. We haven't gotten to the point where people are just fully pulling out quite yet. And so
going to cash.
Yeah. It's going to be really interesting. I think that many of those stocks are not going to, like, we've seen their heyday. I think for many, they're heyday, like that's what I'm talking, like their big heyday. That doesn't mean they're not going to like grow more or anything like that. But when you have, I think Peloton in 2020 went up like 7x over the course of 9 months. Like that kind of heyday, I think is over. That doesn't mean that the Nvidias of the world, right? That's still like, there's a solid business there, really expensive. If you thought Nvidia was great at 100x PE, look at it now that it's 70, But
yeah, don't you know we call it Vidia on this show now?
Yeah, because we can't afford the ad anymore. Anyway.
Oh, totally agree. Anything else in your fishbowl, Doogles?
No, that's it.
All right, guys. Well, again, thoughts with our friends in Ukraine, and thanks for listening to the show. Please hit us with a review or a subscription if you get a chance. That really helps more people find the show. You could subscribe if you love the show, supercast.skippydoogles.com. And you can hit us for all things, including social media links and everything else, skippydoogles.com.
Thank you.
Thanks.